This is Quent Bilo with another discussion on accounting for investments. This talk will primarily be about companies holding stock investments of other companies, with a very brief comment about the term consolidated financial statements. The central issue about holding stock investments is the degree of ownership held by the investor. 3 different scenarios. As we've seen earlier, corporations generally invest in debt or stock securities for one of 3 reasons. They have excess cash, they want to generate some earnings from investment income, or for strategic reasons. Stock investments is the focus of this discussion, and the strategic reason cited above mainly comes into play when there's a significant degree of stock ownership, above 20%. That is, sufficient enough to exert significant influence over the investee. If there's a low percentage of stock ownership, any such investment is treated like similar to buying a debt investment of a company. In other words, the motivation is not for strategic reasons. We'll get into this further. So an important part of this chapter is how a corporation reports the investment. It depends on the corporation's intentions for that investment, that is, how long it intends to keep the investment. For example, a stock investment is made, if it's made for purposes to control the corporation. The degree of control depends on the percent of stock ownership. So we'll see that the accounting treatments will vary based on this percent of ownership, this degree of influence held. This accounting is discussed from the perspective of the investor company, one making the investment. In other words, what's reflected on the books of the investor. So 2 types of investments. We previously visited debt investments, buying the bonds of another company for interest income. We'll focus on equity investments, buying the stock of another company, either for dividend income or share price increases, or perhaps for control purposes, for strategic reasons. Again, the degrees of ownership, of stock ownership, will have different accounting treatments. So the accounting depends on the extent of the investor's influence over the operating and financial affairs of the issuing corporation. How controlling is that equity investment? This is a matter of degree. We'll see 3 different circumstances. An investor's ownership of the stock of another company can range from a really small amount to 100%. 3 ranges are defined for our purposes: 0 to 20%, 20% to 50%, and above 50%. There is a different method of accounting based on these 3 ranges. They represent the investor's degree of influence over the investee corporation. And the 3 methods of accounting are listed in the middle of the page: cost, equity, and consolidation. We will have little interest in consolidation accounting, which is listed last. I just want you to know that it kicks in when voting stock ownership is above 50%. So again, the 3 methods of accounting for stock investments: the cost method, the equity method, and the consolidation method. The choice of methods to account for stock investment is dictated by ownership degree. It's not a discretionary selection by the company making the investment. The cost method is the simplest. The equity method is more involved in its accounting. And the consolidation method, again, I just want you to know when this method is used, not the details of it. We'll focus on the first 2. So the first method, holdings of less than 20% of an investee company. Corporations will use a cost method of accounting for this investment. Under the cost method, companies record the investment at cost and recognize revenue only when cash dividends are received. No income recognized until dividends are received. Cost includes all expenditure necessary to acquire these investments, the price paid plus any brokerage fees. This is normal. So investments are recorded at cost, and under the cost method, we keep that original investment account at cost, unchanged. Let's look at an example. On July 1, Sanchez Corporation acquires 1,000 shares, which represents 10% ownership of the Beal Corporation. So Sanchez is the investor, Beal Corporation is the investee. Sanchez pays $40 per share for this. The entry for the purchase is as follows. Debit stock investments, $40,000, increasing that asset account. Crediting cash, $40,000, decreasing that asset account. So we've just used our temporary cash to buy an investment in another corporation. Continuing this example, during the time that the Sanchez Corporation owns this stock, it'll make entries for any cash dividends received. So if Sanchez receives a $2 per share dividend on December 31st, the entry is as follows. So it's 1,000 shares times $2 per share cash dividend, or a $2,000 cash dividend. Debit cash, increasing that account, and credit dividend revenue, $2,000. Increasing that account will appear on the income statement. Now, under the cost method, this is why the investment was purchased, to obtain dividend income or earnings from it. The accounting is very straightforward. There's nothing complex under the cost method. Note that the original stock investment account is not changed upon dividend receipt. Staying with this example, assume that the Sanchez Corporation sells this stock for $39,000 on February 10th. Now, the original stock cost $40,000, so Sanchez is going to incur a $1,000 loss. Let's look at the entry to sell this stock investment. Debit cash, increasing it for $39,000, the proceeds on sale. That's what we're obtaining. We credit the stock investment account $40,000. We're giving up that investment. We're decreasing that account with that credit. And since we're receiving less than our original cost, we incur a $1,000 loss on sale investments. $1,000 will appear on the income statement. Let's move to the next method, the equity method. This is when an investor holds between 20 and 50% of an investee. The equity method records the original investment at cost, no change there, but subsequently adjusts that investment cost account each year for the following events: the investor's proportionate share of the earnings or losses of the investee, and dividends received by the investor as paid by the investee. So that original investment account at cost will be increased for the investor's share of earnings, or decreased for its share of losses, and decreased for any dividends received by the investor. The equity method, as noted, is more complex than the cost method. Watch its reporting very carefully. Review question. Under the equity method, the investor records dividends received by crediting what account? So we're going to debit cash and credit what account? We'll credit stock investments. Why? We're not crediting dividend revenue under the equity method. Rather, we credit the stock investment asset since it's a reduction in its value. The investee paying company has reduced its value by paying out cash, so the investor reflects that decrease in their investment account. Now, they're increasing their cash for it, but they're decreasing their stock investment. The stock investment account goes down when dividends are received from the investee corporation, because that investee corporation has lowered its value by using its cash in paying that dividend. Review question. Under the equity method, what must the investor do when its investee company announces an earnings result? A, nothing since no cash is paid. B, take the CEO out to lunch. C, send a congratulatory email. Or D, records a revenue entry. What should the investor or company do? D, record a revenue entry. By announcing earnings, the investee company signals an increase in their internal value. The investor or company needs to reflect this on their books under the equity method with a journal entry. Now stay alert here. The upcoming example using the equity method of accounting for stock investments will change the original investment cost account directly. The changes coming up relate to internal changes to the investee's value, either announced earnings or losses by it or cash dividends paid by the investee to the investor. Both events change the inherent value of the investment on the books of the investor. So our example, the Millar Corporation, who's the investor, acquired 30% of the common stock of the Beck Company, called the investee, for $120,000 on January 1st. Then at year end, the investee, Beck, reports net income of $100,000 and paid cash dividends of $40,000 in total. Let's prepare all these entries for these transactions. January 1st, acquisition of the investment. Debit stock investments, $120,000, increasing it. Credit cash, $120,000, decreasing that asset. We've seen this before. Investing excess cash in another company, the stock of another company. Now at year end, Beck reports net income of $100,000. What entry should Millar make? Their share of that income, 30% of that $100,000, will debit or increase the stock investment account on the books of the investor, Millar. What's the credit? Revenue from stock investments, $30,000 increase. That's reported on the income statement. Now note that in this entry, no cash has been exchanged. No cash has flowed here. But we'll make an entry recognizing that the value of our investee corporation has increased because it announced earnings. The investor books its share of the earnings of the investee just upon its announcement of earnings. And the $40,000 that Beck Company paid in dividends, again, 30% of that, or $12,000, is sent to Millar Corporation. So Millar will debit cash, $12,000, increasing that account, and credit stock investments, $12,000, decreasing that account. The dividends paid out reduce the assets or value of the investee corporation, and we're reflecting that on the investor's books by bringing our stock investment account value down with a credit. Again, we're on the books of the investor corporation. Let's look at this example closer by looking at the T accounts on the books of the Millar Corporation, the investor. Again, the previous example, now just looking at the effects of the journal entries. After Millar, the investor posted transactions for the year, its original investment and revenue accounts will show the following detail. The stock investment account has been increased by its share of the earnings, or $30,000, a debit to that asset account, debits increase assets, and $12,000 dividends received will decrease that stock investment account. By the way, the other side of the entry to the $12,000 cash dividend is to increase cash and credit stock investments. We see the other side of the earnings entry here, which is going to a revenue from stock investment account on the income statement. So, under the equity method of accounting, the stock investment account on the investor's books will increase for the share of declared earnings and decrease for any cash dividends received from the investee. Again, share of earnings will go up, will increase the stock investment account. Cash dividends received will decrease that stock investment account. We're reflecting the inherent internal value of the investee as they take those actions, declaring earnings, paying cash dividends. Let's move to the third scenario, holdings of a stock investment that are more than 50% of the investee's ownership. This is the final stock investment method. There's a high degree of control exercised over the investee. If the investor owns the majority of the voting stock, we will not concentrate on the details of this method. I just want you to recognize when it should be used. That is, when stock ownership exceeds 50% of the value of the investee corporation's stock. In this scenario, a controlling interest exists. That is, one corporation acquiring a voting interest of more than 50% in another corporation. The The investor is referred to as the parent corporation. The investee is referred to as a subsidiary. They're the ones that have been bought. The investment in the subsidiary is reported on the parent's books as a long-term investment, and the parent generally prepares consolidated financial statements. It combines or merges the full financial statements of both the entities. This is the end of the discussion on the consolidated method. Additional information is beyond the scope of this course. Let's go back to the holding period of investments. A review of terms we've heard under the debt investment discussion as well. 1. Expected short term. 2. Longer or indefinite. Or 3. Held to maturity. Now we'll review the technical terms related to these three time frames that we've seen earlier. These time periods impact where the investment asset is reported. That is it a current asset or a long-term asset? And those time periods also impact how any fluctuations in value while being held need to be reported on the other side of the equation. Fluctuations in value while being held are called unrealized gains or losses. What do I mean by the other side of the equation? Well, either the income statement and the retained earnings account ultimately, or not reported in the income statement, but a new equity line on the balance sheet. So the three categories of securities, these technical terms, they apply to both debt and stock investments, but only for stock investments that are less than 20% of the stock ownership of the investee, trading securities, available for sale securities, and held to maturity securities. The trading securities, and we've seen this before, the shortest time frame for holding, available for sale, somewhat longer, indeterminate time frame, and held to maturity, the longest time frame. The time of expected holdings of the investment affects the accounting classification. The guidelines we'll discuss apply to all debt securities, all debt investments, and all stock investments in which the holdings are less than 20%. So only certain stock investments are triggered by these classifications. Now, by the way, most temporary stock investments will fall into the less than 20% ownership category. That is the cost method. Again, this is review trading securities. Companies hold trading securities with the intention of selling them in a short time. Trading means frequent buying and selling. Companies report these trading securities at their fair value and report changes from cost as part of net income. So we have an initial cost, and as the market value changes, we report those at a fair value at period end. External market value is another term for fair value. And as fair market value rises while holding on to them, any gain or loss is reported in the income statement. Any changes from cost, these are the fluctuations in value I'm referring to. Illustration. We've seen this entry before in the debt talk. Let's review it quickly. PACE has two trading securities, short term, one in bonds, one in stock. They bought for $140,000. At December 31st, they determined the total fair value of those two investments to be $147,000, or a $7,000 increase. We need to make a journal entry for this reflecting fair value of these combined investments. Debit fair value trading, $7,000. This is a modifying asset account. This is what will modify the original cost values on the books of the investor. Credit, unrealized gain dash income, $7,000. It's unrealized because the securities are not yet sold, but there's been a change in market value. Available for sale securities. Companies hold these with the intent of selling these investments sometime in the future, not known. These securities can be classified as current assets, or they could be classified as long-term assets, depending upon the intent of management, how long they intend to hold on to them. Companies report available for sale classified securities at fair value and report any changes from original cost as a component of the stockholders' equity section. These changes from cost cannot flow through the income statement. We'll see an illustration shortly. So how would the entries for changes in the fluctuations in holding value of these securities, if they are classified as available for sale, how would they change from our previous entry we saw? Again, the only change here is that available for sale means holding for a longer term. Now, the entries would be the same, except that the unrealized gain or loss account can't be called income. We have to call it equity. So don't use the income modifier to the unrealized gain or loss, but an equity subtitle account. Any unrealized loss would be deducted from a new stockholders' equity section rather than charged to the income statement. We have to keep these fluctuations out of the income statement. So any unrealized gains will be added to a new section. Any unrealized losses, as noted, will be deducted from this new section. Let's look at an example. Again, available for sale securities, meaning that they're not held strictly for the short term. They're held for a longer term. Companies can have both bonds and stocks in these categories. Here, the initial cost for these two securities was $293,000 and change, and their fair value at December 31st is determined to be $284,000. In other words, a decrease of $9,537. We have to reflect this change in fair value on the books of Albert Corporation, who's the investor corporation. Journal entry. Credit fair value adjustment available for sale. That credit decreases the value of our assets. That fair value adjustment is a modifying asset account that will be used in combination with the original cost accounts to finally report our values on the balance sheet. What do we debit? Unrealized loss dash equity, $9,537. This will not be reported in the income statement. I want you to see an association between the use of the equity term on unrealized loss and the available for sale classification. Any available for sale classification security, any fluctuations in value before they're sold cannot make it to the income statement. So let's remember, any unrealized loss or unrealized gain on available for sale securities is hung up on the balance sheet. It can't be reported in the net income statement, but is reported as a separate component of stockholders' equity. This reporting allows fluctuations in market value while the investment is held never to hit the income statement. Rather, they go against what I call a buffer account in the balance sheet until they're finally sold and a realized gain or loss is reported in the income statement. The held to maturity classification, this is applicable to bond investments and not for stock. It's put under long-term assets, and I'll not discuss this under the stock investments. It's not applicable for stock investments. Let's talk further about realized versus unrealized gains or losses. An unrealized gain or loss occurs not because we sold the security, we've held on to it and its market value has fluctuated. So any unrealized gain or loss on available for sale securities, those held for not the short term, must be reported as a separate component of stockholders' equity. On the highlighted line below is this separate new line. We cannot flow these unrealized gains or losses on available for sale securities through the income statement. They cannot end up in retained earnings. They must be reported on a separate line as indicated below. I call this account a buffer type account in the balance sheet. Unrealized gains or losses not yet hitting the income statement. Both realized and unrealized gains or losses come from changes in asset values. We've seen this diagram before. This discussion occurred under the debt investment talk and will not be repeated here. I want to mention, though, the same principles apply to stock investments. Realized gains go to the income statement. Unrealized gains can go there too if the investment is classified as a trading security, short term. Else, all other unrealized gains or losses on interim reports can't go through the income statement. They're hung up on the balance sheet on this new separate line in the equity section. Let's look at the asset section one last time. How are investments reported? It'll depend on how long the investor intends to hold on to the investment security, a very short time or a somewhat longer indefinite time period. In other words, we're talking about a current or non-current asset reporting classification. Here we're looking at the asset side of the Pace Corporation's balance sheet. If investments are intended to be short-term, they'll be reported as a current asset. Both short-term bonds and stock investments are in this category. And both will be periodically stated at fair value using a fair value adjustment account, a separate valuation account to modify investment cost to fair value. Stock investments that represent less than 20% ownership might appear in the current asset short-term investment section. If the intended holding period is not expected to be short-term, the investment must be classified as a long-term investment below the current assets section. These will commonly be stock investments, but could include a bond investment held to maturity. Now, the stock investments that appear in this longer held investment section include investments of less than 20% using the cost method, or stock investments owning between 20 and 50% of the investee corporation needing the equity method treatment. Again, the classification of the investment in this lower section all depends on the intention of the investor or company. How long does it plan on holding the investment? Investments in the non-current asset section simply signals to the readers that these investments will be held longer than short term. Don't forget that the accounting for stock investments depends on the percent of ownership. So there could be two types of accounting going on in this investment section. Cost method accounting, keeping the original investment account at cost and only booking revenues when cash dividends are received, or the equity method accounting, which is more complex. In any event, fair value changes are also recorded using a separate fair value adjustment account for all short-term investments, but generally only for stock investments of less than 20% ownership. This presentation does not demonstrate the consolidation method. Those details are not part of the scope of this course. Fair value reporting. Let's review again what this means. In any reporting period, any investment on the books must be reflected at its current fair or market value. We're talking about an external market price. We need to keep the original investment cost and account intact, but we use a fair value adjustment new account, which is a modifying asset account, to reflect changes in period end market values. That account is not actually shown on published balance sheets, but its value is combined with the original investment cost account before being reported. Can this original investment account for stocks ever change in value as we're holding on to it? Not when the cost method is used. In other words, when stock ownership is less than 20%, see the prior page, any fair value adjustment uses a separate account. It does not touch the original cost investment account. But if the equity method is required for stock investment reporting purposes, in other words, ownership is between 20 and 50%, the original investment account will directly be changed for two events: increasing it for the share of reported earnings in investee, these are announced earnings, no cash flowing, or decreased for announced share of losses, and decreased for any cash dividends received from the investee. These last two changes are not fair value changes. They are not based on external market prices, but rather the internal value of the investee corporation itself. Values changing for the inherent internal value of the investee. Reported earnings and dividends paid. Now, the equity method requires focused study. We need to distinguish between two changes in value. One, the periodic monthly changes in external market prices, what the stock could be sold for. This is called fair value accounting. And an inherent value of the investee simply based on internally announced earnings or losses and paying cash dividends. The equity method, the original investment cost account will be changed for these last two events. However, for the equity method, we generally will not use the fair value accounting, the external market price. Generally not used. So we'll concentrate on the inherent internal changes within the investee itself, these two events, announced earnings or losses, and cash dividend payments from the investee to the investor. The fair or external value accounting, as noted, is generally not applied to stock investments required to use the equity method of accounting. That is, ownership between 20 and 50% of the owned by the investor. Let's take one last look at the balance sheet to see what you don't see. For short-term investments in the current assets section, these can include either bond or stock investments. These are both recorded at cost, but they're periodically, monthly, updated to their fair value using a separate account. We call these trading securities. That's what merits their classification under current assets, short-term investments. Under long-term investments, we can have stock investments of less than 20% ownership and stock investments of ownership between 20 and 50%. The first uses the cost method. The second uses the equity method. These are called available for sale securities. That's what calls for their classification outside the current asset section in a non-current investment section. Now note that short-term investments use fair value accounting at month end. Long-term investments in stock of holding less than 20% ownership use a fair value accounting, but investments in stocks between 20 and 50% of the investee's outstanding stock do not use fair value accounting. We use the equity method and do not adjust for external market prices, generally speaking. Here's a bird's eye view of accounting classifications and methods of accounting. Investment stocks representing less than 20% ownership will use the cost method and periodically record fair value changes in a separate fair value adjustment asset account. This is a modifier asset account. Any unrealized holding gains or losses are treated as indicated under this method. This varies whether the investment is classified as a short-term trading security or a longer-term available for sale investment. But when the equity method is required for stock investments, that is, holdings between 20 and 50%, the accounting is different. This ignores the fair value adjustment on a monthly basis, but will record two events of the investee directly to the original investment cost account for this method. This would be a good chart to print out when working problems for this chapter. Again, we don't expect to use this type of adjustment, this fair value adjustment, for the equity method investments.